I'm Dr. B, and yes, I'm a real ER doctor, so you may be wondering, what am I doing here in this space? Well, after years of pain from sports injuries, I listened to my doctor and had to pivot into a career that would keep me off my feet as much as possible. I also have a degree in finance, and so it was a natural transition to join Verified Investing. I'll share my prescription for becoming a successful investor right here on the Market Pulse. I'm Dr. B. Welcome to the Market Pulse here at Verified Investing. Today is going to be an interesting episode where I show you how I time my entries and exits, whether it be trading, long-term investing, from the 1-minute chart to the daily and weekly charts. I hope you enjoy this. Let's get to the charts. All right, so the first thing you need to understand before we get to the charts is that the S&P is the market leader, right? It essentially is the conductor of the market, at least for U.S. equities, right? And so there's an interesting phrase that you've probably heard before: a rising tide lifts all ships. Well, I've expanded on that and said a rising tide lifts all ship and a falling tide grounds all ships, right? And so the goal is to really time our entries into equities based on what the S&P 500 is doing. So let me give you an example. So this is the 1-minute chart on the SPY, which is the ETF of the S&P 500, okay? And this is the 1-minute chart on SMCI, a big semiconductor company, okay? And you can see that at 10:54, okay, today, Monday, April 8th, you had the S&P here at resistance at the same time that SMCI was at resistance, okay? And what you can see, you've got this resistance line right here, okay, which the price came up into, and you also have what's called a parallel channel. We'll have another episode on chart patterns where I'll talk about double tops, double bottoms, parallels, head and shoulders, inverse heads and shoulders, things like that. But take my word for it, this is a parallel channel. And you can see here that this was resistance on the S&P, and the S&P then started to fall. When the S&P is at resistance, I'm looking for shorts, okay? I'm looking to short stocks, and you can see over here that SMCI was also at resistance. This pivot low here became resistance here, all right? And you have a little micro double top here, but also this was the resistance. So what I did here is I shorted SMCI somewhere in this area, all right, at the same time that the S&P was at resistance. And look at what happened. Both of them fell. And that really has increased my trading abilities and investing abilities by being able to time the S&P with my entries on equities. So let me give you a couple other examples here. So this chart is, again, the S&P's on the left, Tesla's on the right. This was earlier today. Okay, and you can see here that you have two parallel channels, all right? We talked about the S&P being at resistance here, also with the parallel acting as resistance. And then Tesla is also into a parallel, which is acting as resistance. And the same time here, this is 11:20 today, 11:20. And so this is where we could have entered a short on Tesla, right? Because that is exactly where, and again, it's not perfectly lined up. You have to understand that there's sometimes a lag, but in general, again, a fall in the S&P led to a fall in Tesla, right? So we did a semiconductor. This is a car company, but also somewhat of a tech company. Let's go to another type of industry here. All right, so JP Morgan. This is a bank stock. And so it even works with the bank stocks. Again, S&P 500, 1-minute chart here at 11:09. All right, 11:09 today. We know why there's resistance here, parallel channel, trend line. And you can see here that at 11:09 on JP Morgan, you had all of these pivot lows acting as resistance, okay? And right at 11:09, when the S&P started to pull back, so did JP Morgan. And I actually zoomed out on this chart. You can't quite see the entire move, but I wanted to show you why there was resistance here on JP Morgan. So as you put these together, it's really powerful to see how equities essentially follow the S&P. Right? So let's say, hey, Dr. B, I don't really like to look at the 1-minute charts. I would rather look at the daily and the weekly charts. Well, no problem. So the S&P on the left side and Salesforce on the right, you have the same date here, Monday, October 17th, 2022, Monday, October 17th, 2022, right? So both charts are lined up. And you know from the Fibonacci episode, and if you haven't watched the Fibonacci episode, go back and watch that episode. You can see here that you have the COVID lows, 2022 highs, and then 2022 lows. And we've pulled a Fibonacci here, and you can see the 0.5 Fibonacci retrace. That is likely the point of a bounce. And we saw here that the S&P bounced significantly at the same time, almost, wasn't perfect. It was within maybe a week or two that the S&P and CRM bounced in tandem. And we saw the same concept on the short side being played out here on the long side. So as the S&P starts to move higher, so do other equities. And that's really, really key to understand. So here is a couple things that this accomplishes, right? So it allows you to drastically increase your probability of success that your trades will work out. And what it does also is it gives you another factor before you enter, or exit your trades, and you can say, hey, S&P's at support, so is Tesla or Salesforce or any other company. This is likely a good time to get in, or maybe it's at resistance. Maybe this is a good time to exit my trade. So very, very important there. Here's another idea with, or example with Meta, okay? We can see here that on Monday, October 17th, when the market's bottomed, we see this falling wedge pattern here that broke out, and then it retraced and then moved higher. So you can say, hey, Dr. B, I was following this pattern on the S&P. I knew it was likely to go higher. Plus, we had the 0.5 Fibonacci level there. And, I was looking at a couple companies, but I didn't really know what to buy or if it was the right time to buy. We had a lot of factors here. The market, it was oversold. We had a falling wedge that retraced to the scene of the crime. We have bullish divergence. We talked about the 0.5 fib level right here. Okay. And again, go back and watch the RSI episodes, the Fibonacci episodes, and you'll see what I'm talking about. So we had a lot of reasons for a bounce here. And you could have said, hey, wow, look at Meta's chart. Look at how oversold Meta is. Came from almost $400 down to around $80. Now notice here that there really wasn't any technical levels for a bounce on Meta. And this is really key that you understand this. There's no technical levels. If you were to draw this trend line doesn't match up. This trend line doesn't match up. There's really, this trend line doesn't match up. So the reason that Meta bounced right here on October 17th or around that time, maybe within a couple days, plus or minus, is because the S&P bounced at that time, okay? So again, a rising tide lifts all ship. This is the tide, okay? The S&P is the tide, and the equities are your ships. This is a very, very important concept to understand. It works on the long side and also on the downside, which is why it's so important to chart the S&P continually to understand, hey, when is the market likely or equities likely to roll over, and when are equities likely to run? So that's Meta's chart. And we'll go over here to, let's see, AMD. You can say, hey, Dr. B, I really don't like trading on the 1 minute or the weekly charts. I prefer to trade on the hourly charts. No problem. So Thursday, October 4th, we see here that the market, remember this is the Thursday when the market had essentially a 2% swing, right? Big swing intraday, huge red candles. And you can see here right at 1:30, okay, AMD also had several red candles there. So it happened at the same time. Now, my idea is that if you look at AMD and NVIDIA, right, they both triggered a head and shoulders pattern at the exact same time. We know that the semiconductors are ruling the markets, and I do believe that one of the reasons we saw such a big drop in the S&P that day was actually because of the semis were triggering a head and shoulders pattern. Head and shoulders pattern is a bearish pattern, whereas an inverse head and shoulders pattern is a bullish pattern. So a couple things, and I hope this shows you how interrelated the S&P and equities are, together. So it's very important to understand this. You can see now that this works on all time frames, from the 1 minute all the way to, say, even the monthly charts. So I hope that helps. And practice this. Go through your charts. Practice, and then you will find that typically it doesn't always work this way, where the S&P goes up and equities go up, but in general, that's how it works. And so by knowing technical analysis, having all of your levels together, you're going to be much better off at, having successful, profitable trades in the long run. So I hope you enjoyed that episode. This was a great episode to understand how the markets are really correlated, how the S&P is correlated to U.S. equities. Very, very important. It will drastically increase your success and your profits in the market. I also have developed a course called the 1 Minute Scalpel, where I zoom out from the weekly charts all the way into the 1 minute charts, where I've found a lot of alpha and edge in the markets. The people in the live day trading room or the Apex trading room can attest that we have trades almost every day, multiple winning trades on the 1 minute technique that I've developed. I've spent years improving my craft and sharpening the saw to help myself and also you profit in the markets. It's about a 2 or 3 hour course, about $300, and it really is insightful. I'm so excited to share this information with you. You can sign up in the link below. And again, I hope you enjoyed this episode. I'll see you next time on the Market Pulse. Take care.